why at EMA we use ETFs, exchange-traded funds, to construct client portfolios. We use them instead of mutual funds. ETFs are more cost-effective, they're more tax-efficient, and they offer better transparency to investors. First of all, mutual funds have higher expense ratios as a general rule than do ETFs. In addition to having higher published expense ratios, mutual funds also have unreported internal trading costs. By unreported, I mean not reported in their expense ratio. They can only be found in a document called the Statement of Additional Information. How many investors have even heard of a Statement of Additional Information, let alone been delivered one when they've been sold or purchased a mutual fund? ETFs generally do not have unreported trading costs because ETFs are created and redeemed in kind. According to a study by the CFA Institute called Shedding Light on Invisible Costs, trading costs of mutual fund performance, published in 2013, the average unreported trading cost for equity mutual funds, that's stock mutual funds, is 1.14%. That can be a very significant drag on investor performance. Now, the CFA Institute isn't alone in taking a look at this issue of expenses in ETFs versus mutual funds. Forbes also wrote about it in an article called "What's the Difference? Mutual Funds and Exchange-Traded Funds Explained" in 2013. Now, just looking at that expense ratio and not taking into account unreported trading expenses, Forbes concluded that ETFs were significantly less expensive. Here you can see 6 different mutual fund and ETF categories with average cost comparison of ETFs far lower. Now, to be fair, active mutual funds at least have an opportunity to beat an ETF because of their active management, but equally they have an opportunity to underperform. So, all of the things being equal, we prefer the lower cost exchange-traded fund. And when it comes to taxes, ETFs beat mutual funds hands down. Now, both are regulated by the Investment Company Act of 1940. Both are required to distribute their realized gains. Now, realized is the operative word. Because mutual funds take in cash and distribute cash and buy and sell frequently, particularly in an active mutual fund, any gains realized through the buy and sell process must be distributed annually. But because ETFs create and redeem their shares in kind, they do very little trading inside of the investment company vehicle and therefore distribute little to no capital gains, making them far more tax efficient than traditional mutual funds. In fact, Morningstar reported back in 2012 in a study called ETFs Under the Microscope, a tax efficiency survey, that the average capital gain distribution as a percentage of assets in several mutual fund categories that you see here is very substantial. Taking a look at the top category, large cap mutual funds, actively managed mutual funds distributed on average 1.92%. Apply your tax rate to that. You get an idea of the incremental costs. Passive mutual funds far less, but in all 3 of the categories you see on the screen, as published in this report by Morningstar, ETFs had no capital gain distributions. Again, a significant savings for investors. Now, the last reason ETFs are superior to mutual funds is transparency. Mutual funds are required to disclose their holdings to investors, and they have up to 45 days at the end of a quarter to disclose to you what you own. ETFs, on the other hand, publish their holdings all day up to the second during market orders because they track indices, and indices have readily available constituents and components. Now, at EMA, we follow an asset allocation process that's designed to give investors broad exposure to multiple asset classes and thousands of individual securities. We're trying to replicate the institutional consultant style of investing. We differ from an institutional consultant in that we recognize that individual investors aren't looking to invest billions of dollars the way institutions are. So we rely on low-cost and efficient vehicles, ETFs, where institutional investors might go for multiple managers in every asset class. As an example, our portfolios include equity exposure to different asset classes, alternative investments, which could include things like commodities or hedge fund replication, fixed income, everything from corporate and high yield to government bonds, preferred stocks, and finally, cash.